Welcome back. I am Dr. Kris of Dr. Kris Key to the Manager's Mindset, your go-to for building financial intelligence and leadership skills. Today, we are tackling a fundamental topic: how to analyze a company before you invest. Forget chasing hot stocks. Real investing is about understanding value and making informed, strategic decisions. I'll walk you through 7 actionable steps to help you confidently evaluate any business, whether you're a beginner or looking to sharpen your approach. This is the foundation for building long-term wealth and a resilient portfolio. Ready to level up your investing game? Grab a notebook. Let's dive in. Step 1. Truly understand the business you're considering. Before you put any money on the line, you need to know exactly what the company does and how it operates. Can you explain, in simple terms, how the company makes money and what problem it solves for its customers? If you can't, you're not ready to invest yet. If you're unsure, pause and dig deeper. Read annual reports, listen to earnings calls, and study the industry until you're confident in your understanding. Take Netflix, for example. It didn't invent movies, but it completely changed how we watch them by solving the problem of inconvenient, scheduled TV. That's a clear business model. Next, look for a competitive moat, a lasting advantage that protects profits and keeps competitors from easily copying the business. This could be a powerful brand like Coca-Cola, which people recognize and trust all over the world. Exclusive patents that protect the pharmaceutical company's unique drugs, or a network effect like Facebook, where the value grows as more people join and interact. Cost advantages matter too. Walmart's world-class supply chain lets it undercut competitors and maintain its edge. Always ask yourself, what keeps rivals at bay? Is the company's advantage truly durable, or could it disappear overnight? If you can't spot a moat or a clear edge, be cautious and consider passing on the investment. Understanding the business and its defenses is your first and most important filter for smart investing. Don't skip this step, no matter how tempting the opportunity. Only invest in what you truly understand, so you can make decisions with confidence and clarity. That's how you separate speculation from real investing and set yourself up for long-term success. Now, let's look at the numbers. This is where you separate fact from fiction and get a true sense of a company's performance. Is the company financially healthy? That's the first question every investor should ask before putting money on the line. Start with revenue and net income trends over the last 5 to 10 years. Are both steadily rising? Consistent growth signals stability and resilience, even during tough times. Look for dips or erratic swings, which can be red flags. PE, price to earnings, shows how much you're paying for earnings. Compare it to industry peers to see if the stock is overvalued or a bargain. Debt to equity reveals leverage. Too much debt is risky, especially in downturns. A balanced ratio means the company isn't overextending itself. Return on equity, ROE, measures how well management uses shareholder money. Aim for 15% or higher. High ROE often points to efficient leadership and a competitive edge. Free cash flow is crucial. Is the cash left after expenses, fueling dividends, buybacks, or growth? Without it, a company can't invest in its future or reward shareholders. The current ratio shows if the company can cover short-term bills. Above 1 is good. It's a quick check for financial safety. Use free tools like Yahoo Finance to find these numbers. Most data is just a few clicks away, making research easier than ever. Focus on trends, not just one-off results. Patterns over time reveal the company's true direction. Healthy financials are the backbone of a strong investment. They provide confidence and reduce risk. If the numbers don't add up, move on. There are always better opportunities elsewhere. Don't let hype blind you to financial reality. Always trust the data over the noise. Numbers tell the real story. Let them guide your investment decisions every time. Great companies need great leaders. Research the CEO and top executives. Do they have relevant experience and a track record of smart decisions? Read shareholder letters for transparency and honesty. Check if management owns significant stock, skin in the game, aligns their interests with yours. Founder-led companies, like Tesla under Elon Musk, can be innovative, but also risky if too dependent on one person. Look for vision, integrity, and wise capital allocation. Avoid teams that hide bad news or chase flashy, unprofitable projects. Leadership shapes the company's future as much as the numbers do. Trustworthy, capable management is non-negotiable. If you wouldn't trust them with your money, don't invest. Scrutinize the people, not just the product. No company stands alone. Industry context matters. Is the industry growing or shrinking? A strong company in a dying sector faces headwinds. Assess the company's market position. Leader, challenger, or niche player. Is it gaining or losing market share? Use resources like Statista or Morningstar for industry data and competitor analysis. Identify main rivals and compare financials, growth, and strategy. Don't get fooled by a cheap stock if the whole sector is struggling. Look for sustainable leaders in healthy, expanding industries. The best house in a bad neighborhood is still a risky bet. Context is everything. Every investment carries risk. Smart investors face this head-on. Identify market risks, like recessions, and company-specific risks, like reliance on one supplier or regulatory threats. Read the risk factors in the annual report for a reality check. Ask, what could go wrong? What's the worst-case scenario? Don't ignore red flags. Sometimes walking away is the best move. No company is risk-free, but you want risks you understand and can accept. Being realistic about risks protects your capital. Preparation beats optimism every time. Now, is the stock price fair? This is one of the most important questions for any investor to ask before making a decision. Remember, even a great company can turn into a poor investment if you overpay for its shares. Price matters just as much as quality. Start with the PE ratio. Compare it to industry peers and the company's own history. This helps you see if the stock is expensive or cheap relative to others. For growth stocks, use the PEG ratio, PE divided by growth rate. A peg around 1 suggests fair value, but always consider the company's future prospects too. For unprofitable or cyclical companies, check the price to sales PS ratio. This can give you a clearer picture when earnings are volatile or negative. Don't rely on just one metric. Use several valuation tools together to get a more complete and accurate picture of the company's worth. High valuations can signal hype and excitement. Low ones might mean hidden opportunity or sometimes real trouble lurking beneath the surface. Your job is to separate excitement from true value and avoid getting swept up by market emotions or trends. Look for quality at a reasonable price, not just a bargain. The best investments balance value and business strength. Valuation is your defense against market mania and helps you avoid costly mistakes. Be patient. Wait for the right price. In investing, discipline and patience always pay off in the long run. Finally, look ahead. Where will growth come from? Is the company expanding into new markets or launching new products? Does it invest in innovation and adapt to change? Check the size of its total addressable market, TAM. Big growing markets offer more runway. Is the company riding long-term trends like digitalization or clean energy? Think beyond the next quarter. Will this business matter in 10 years? Build a logical, evidence-based case for future growth. Don't rely on wishful thinking. Ground your optimism in facts. The best investments solve tomorrow's problems, not just today's. Growth potential is the final piece of your analysis. That's the 7-step framework for analyzing any company before you invest. Understand the business, check the numbers, vet the leaders, study the industry, assess risks, value the stock, and look to the future. This process turns you into an active, confident investor. Pick a company you know and try these steps. Share your findings in the comments. If this guide helped, like, subscribe, and hit the bell for more on personal growth and financial intelligence. Thanks for joining me on Dr. Kris's Key to the Manager's Mindset. Until next time, keep learning and keep growing.